And welcome back to Wiser Retire Setup. So you've gone through step one, setting up your family profile, and now we're going to talk about setting up salary and other income. This is very important because whenever you start to create any kind of wealth journey, it's important to understand what you have coming in, what you're expecting it to grow by, because eventually we're going to get to your expenses. So we're going to start off, and as you can see, the system automatically puts salary if you're married for each of you, in addition to Social Security. Now keep in mind, you might be in that category that you are not eligible for Social Security. So I'm going to show you how to handle that. Let's start off just by clicking one of the salary buttons. And again, you may have multiple salaries, so I'll show you how to enter that also. So the income starts. Now you might be starting a new job. You might have an income after retirement. And if you have an income now, go ahead and just put in already started. And then if you plan on, say, semi-retiring and starting a different job, you're going to create a separate salary. So you'll show one entered, one you're currently receiving, and then when you retire, we'll stop this salary and then start another salary. But for now, let's just have income starts as the first area. Now what we want to do is give an estimate of what your annual increase will be. Now typically inflation has been about 2.5% to 3%, and a lot of companies have a cost of living increase. Some companies, however, do not. So it's really up to you whether you just put no salary increase or whether you have seen an ongoing increase. Now the question is, when does that salary end? Now this is where you start getting into some of the triggers. You can set it at a certain age. Why would I want to do that? Or a calendar year. If I'm going to change jobs, or if I'm going to semi-retire to take a pension plan, and then I'm going to start another job, we're going to start this out. We're going to stop this salary at a certain age, and then we'll create a separate salary entry. But for now, we're just going to keep this in, and we're going to put this at age 65. Now, if you remember, I started John at age 50. So John is age 50 right now. So the question is it excluded from Social Security tax? Well, there are certain entities, whether you work on the railroad, whether you are in certain areas as a teacher and you don't put into Social Security, there are certain religious jobs that you have that you can exempt yourself from Social Security. So you want to put in, if you are paying Social Security, just leave that blank. And we're going to go ahead and save. And now let's set up Mary's information. And let's say that she's making $95,000 a year. And as you can guess, I am just kind of guessing as we go along. And this way you can kind of see when we get to the end, I'll just make some minor adjustments. And Social Security, we're going to assume that John is not taking his Social Security already. If you are taking it, make sure you click on here. This way the program will account for that income that's coming in. Now, here's what's interesting. With this program, you can say, I have no Social Security. I'm going to use a simple estimate. I'm going to base it upon full retirement benefits, or I'm going to enter all of my historical data. So for right now, we're just going to use simple estimates, and that's going to be based upon the income that we entered for John. Let's go back and enter that again. And now Social Security will be estimated. Now I can change this. I can put it in and put the actual amount in, just choose based on full retirement benefits. And this is where you can find that little Social Security statement with the little green bar at the top. And you can also, if you're not sure, you can set up a free account with the federal government at ssa.gov, and you can pull your actual retirement down at full retirement. Again, depending upon what year you were born, your full retirement may be 65, or it could go all the way up to 67 years old. So for right now, what I'm going to do is I'm going to put in $2,800 a month as the full retirement benefit. And let's go ahead and just do the same for Mary's. And Mary's, I'm just going to leave on full retirement and let that figure it, or use a sample estimate. Let the system figure it out. Okay, so now I'm going to add in some extra income. And as I said before, if let's say one of the parties is going to retire and then they're going to start a different job, or could even start a business. Now, let me caution you. If you're going to start a business, don't enter it here. This is only for other people that you work for, that you receive a salary. You might retire and start a different business, but we have a different place to put that. So for right now, we're going to leave this open, and let's delete that extra entry. And I'm going to show you some other ones. Self-employment. Okay, well, let's say John's going to start a job. And let's say in that job, the first year, there's an estimate of $15,000. Now, if you need to build this out where you say to yourself, well, you know what happens if I make $15,000 the first year, and then by the second year, I make $50,000? Well, that's going to be hard to compute based upon an annual increase. So what would I do? I would create self-employment income. I would start it in the first year. I would end it at the end of the first year, and then just create a second self-employment entry. Now, the service income. Well, with the Trump tax reform, there is the ability that if you earn less than $157,000 as a single, or double that, about $350,000 or $60,000, you can get a 20% discount on your taxes. It's a tax credit. So an example of, let's say you made $100,000, you would get $20,000 in less in taxable income. In this case, because this is service income, the only reason you're ever going to click this is if you anticipate this exceeding the discount rate range. And again, currently that's about $157,000, or double that if you're married. So right now we're going to put it in a service income. It's not going to make a difference now. It's still going to just calculate that discount off the tax on the $15,000. Let's add a different kind of income. Now, pension income is very important as to how you enter it, and it might take you a little bit of research to figure it out. Now, what we're going to do is let's go ahead and enter in $40,000 a year, and John is the owner. Highly doubtful you're going to have a joint pension, but we're going to leave John in there as the person of the person who owns that pension. And we're going to start this. Let's see, we said we wanted him to retire at, say, 65. And let's say in the year 2020, he's 50 years old, so we have 15 years to go. So we're going to put 2035, he's going to get the pension. Now, this is where it's going to get a little, you have to have the right information. So what the differences are between these things are certain only. What this means is, let's say you get $40,000 a year, and let's say it is guaranteed for 10 years. Well, if you die in the 8th year, they'll continue to pay the beneficiary for 2 more years. If you die in the 11th year, there's no more benefit. Okay, so as you can see, when I change this from life only, there's a survivor benefit right here. And if I change it to certain only, it just tells me how long is the guaranteed period for. Now, some of them have what's called certain and life. And what that means is they'll guarantee a certain amount for the first 10 years. So they might guarantee $40,000 for the first 10 years. Then if you pass away thereafter, it might reduce to some survivor percentage. So let's look at the annual increase. Let's just use general inflation and whatever we program into the system. So this way at the end, when you start making your plan assumptions and seeing how life looks, you can change the planned assumptions, and then it will change what the pension increase is. Now, most people have pension increases somewhere between 1% to 2%. And the cost basis, have you put into this plan? If you have added money to this plan, then when you get paid out, part of what you get paid out will actually be covered by, or will be tax deductible. Let me clarify that. Not tax deductible in as much as it won't be taxed to you. So what is non-covered? A non-covered pension from a government job reduces Social Security spousal benefits. So you got to make sure. There are some people that have government pensions. They have teacher pensions, depending upon what state you taught in, and they might have this kind of reduction. So you got to be careful of that. So we're going to put in here, we're just going to put life only. And what we're going to do is, this is really important. This is one of the things I see that most people, when they set their plans up, they miss it. And it has a huge impact when you get to the planning stage. So the question is, what percentage would your spouse get if you passed away? Now again, this would be if you passed away day one. So you take your pension on Monday, on Tuesday you die, your spouse gets 50%. However, if you have the certain in life, what they might say is, well, the guaranteed period if you retire at 2035 is going to be for 10 years. So it might be until 2045. Okay, and then if you passed away, the spouse would get 50%. So for right now, we're just going to use life only. We're going to put in 50%. Again, the exclusion ratio is if a percentage of your income comes back tax-free, you have to figure that out. Most of the pension companies will be able to figure that out. If you're using the pension income, there are a multitude of ways that you can enter annuities if you're going to annuitize. Some companies give an annuity in annuitization, and this is where you would use this. If you annuitize an annuity, as an example, you put in $50,000 and the annuity is worth $100,000. Well, that other $50,000 has grown tax-free. So when you annuitize it to ask that annuity to give you an annual income, let's say you get $1,000 a month for life. 500 of it would be taxable, 500 would be tax-free, because the ratio of what you put in is 50% of the total. We're going to leave that out for now. We're just going to go ahead and hit save. Let's add some additional income so you can see them. What is a distribution? Well, let's say a distribution could be a 401k distribution. It could be really anything at all. It could be a settlement. It could be a lot of different things, but here we're going to use a 401k distribution. We're just going to leave that preset title as the example, and let's say that there's going to be $15,000 a year that will come in. Now, if you have a 401k and you're invested in stock, I would not use this distribution. This is making the assumption that you have a fixed guaranteed income. Do not use this for anything that fluctuates. So if you have stocks, bonds, mutual funds in your 401k, I'm going to show you where to enter that. Just don't enter it here. Again, this is only for fixed incomes. So for now, I'm just going to go ahead and delete that. And let's hit the last one, which is other. So other, you have income from a multitude of different places. You have child support, alimony, royalties. And again, each of these will be taxed differently, but don't worry about that. We have an area in the back of the program that we're going to set that so we can measure the taxes, and a reverse mortgage. Now let me cover this for a second. There are two kinds of reverse mortgages. There is an annual income reverse mortgage, and then there is a lump sum reverse mortgage. Only enter the income type of reverse mortgage here. If you have the type of reverse mortgage that you're borrowing money out to, say, invest in real estate, invest in stocks, invest in a business, do not use this. This is only used to record ongoing income that you have. Now, let's say that you've sold a property and you hold a note. You might actually put that note within other income because you're holding a note. And so as you can see here, it'll give you a little pull down and you can put in how it's actually taxed. All right, so let's move on. Hopefully this has given you a good understanding on how to enter your income. Remember a couple rules in this area. Do not enter anything that will fluctuate in value, such as stocks. So don't try to estimate what your stocks are going to pay out. That will be covered later. Don't enter a bond interest. Don't enter dividend interest. Only enter salary, Social Security, and things that will be guaranteed or will have a fixed income nature to them. You will enter those other lump sums in a different area. Just don't enter them here. That is it for the income section. Go ahead and progress past this video so we can get to the savings session.